Well, good evening, everyone. Welcome back to the channel. Happy start to the month of September. And to start the month out, we're going to get into covered calls and covered call premiums. So, part of the motivation of this video, I see a lot of different videos, not just on YouTube, but I talk about this stuff all day and I hear a lot of different things. And I think part of my motivation as like a coach or a mentor is the moment I hear someone say, "Oh, you can't do this," or "This would be stupid to do that," I immediately think, why? And I start thinking of ways to get around, whatever obstacle somebody comes up with. So when it comes to covered calls, if you understand the concept of covered calls, obviously the traditional model is if you own shares of a stock, you own 100 shares of the stock, and then you can actually sell call options against the stock and then collect a premium. But the first thought to somebody that may not want to, not that they don't want to do it, but somebody that immediately goes to, like, the roadblock to the solution, may say that, well, I can't come up with the money uh, to own the stock. And especially for stocks that pay juicier call premiums, like say Tesla or Mercado Libre, um, Amazon, Google, Meta. A lot of the stocks that were trading over $1,000 a share now have split. With very interesting, because you had, like, most of the FANG stocks have actually split. I can't recall if Facebook or Meta split, but Apple split twice in the past couple of years, or maybe it's just that one time. Um, and then Amazon just split this year. Used to be a $3,400 stock. Now it's affordable. Um, Netflix, you would think it's split based on the price of the stock today, but it actually hasn't split. It's just dropped so much in value. And then Google, of course, split earlier this year. So a lot of those FANG stocks, again, Facebook, Apple, Amazon, Netflix, and Google, the majority of them have split in the last year. So it's typically, and you could call it the FANG plus T model to include Tesla, but typically the more expensive stocks are going to pay out more expensive premiums. And for you, I just wanted to run through this example here, because for you to be able to run, or to be able to collect call premiums on a stock like Tesla, you would have to own like almost $28,000 worth of the stock. But not necessarily, because like the majority of investors out there, uh, whether you're a poor man or poor woman, let's be inclusive here, right? Um, there is something for that, specifically the poor man's covered call, and that's what I'm going to talk about today. And I think I've mentioned it in other videos, but the idea here, if you don't have a lot of capital that you're sitting on, rather than standing back and saying, well, I can't do this, that's why I just have to watch people with money get richer. Well, it's not the right attitude to have, because like I said, there's something called the poor man's covered call, where all you got to do is own a leap option on whatever stock you want to sell options against to collect a premium. And this may sound really complicated, but so a leap option, as a reminder, is a long-term equity anticipation option, meaning it's a year or more out. And the interesting thing, and not everybody knows this, but most brokers recognize a leap option as the equivalent of holding 100 shares of the stock. Aha, now the light bulb's going off, right? Well, and why is that? Because if you know the basics on options, one option contract controls 100 shares of the stock. So if you were to buy a leap option on a stock like Tesla, and then you wanted to go back and sell options against it, it has the same effect as if you ponied up $28,000, because the stock right now after the split, 27 or $277.16. So you would have to pony up, in the traditional model, $27,716. Whereas with the poor man's covered call, you would just pony up what it would cost for a leap, which I'm going to go into E-Trade now, because Ameritrade didn't want to cooperate with me. I was going to use Thinkorswim, but I'm going to go into E-Trade to illustrate this example. So if we're looking at Tesla here, if we were to go out, remember I said a year because leap option is a year or more out. If we were to buy at a price like this, and this is kind of, those of you that have been following me for a while, this is kind of what I did with Mercado Libre. I had what I'd call a summer fling with Mercado Libre, and it was foolish on my part. I ended up I made a little bit of money, I guess, but I got into some really risky trades. But some of them were like spread trades like this. And the thing is, there's not a big difference between a spread trade and what I'm talking about doing here, meaning a poor man's covered call, because you're buying in to one option, a long position, and then you're selling against it, which may sound risky. Like you may wonder, well, oh, how's that? How's that even legal? Well, it is. I mean, most brokers, like I say, they recognize if you're controlling 100 shares with one contract, they recognize that as the equivalent of holding 100 shares of the stock. The only caveat to it is that you at least need that money in your account as collateral, or if you trade on margin, you at least have to have the money. So you would still have to have like 28,000. And here's the thing, if you have like 30,000 in your account, they're going to let this go through because they see that the money is there. And if you've elevated your options approval levels to like option level 2 or 3, you're going to be able to do this and you'll be able to trade on margin. Do I recommend trading on margin? Typically not. But those of you out there that are really, hungry to advance in life and you want to make a difference, and if you feel confident and practiced enough, and you've practiced in paper trading, which anybody can do, by the way, go open up an Ameritrade account and just they give you 200,000 and like free like monopoly money, play money. You can go practice your option trades for 6 months, and then if you've tried your hand at that and feel comfortable enough, you can go into real trading and do it. And there are people out there that like stocks are great and all, but like there's people that want, and they're looking for something to change now. Well, options has that power, and yeah, it can be risky, but if you know what you're doing and you're practiced at it, you can make money. You can find ways to make money with a high probability of the trade being successful. And most brokerages will tell you the probability of the trade being successful. If you can get to like 85% and above, those are really good odds. And remember, with a premium, no matter what happens, you're going to keep that money regardless. The money's yours. And like I say, with a covered call, the worst thing that can happen probably is assignment, but you'll want to either roll the trade or get out of it before you come close to assignment to avoid assignment risk. Because once an option becomes in the money, it has what's called intrinsic value. And what that means is that it's in the money. So every dollar that it's over, it's in the money threshold, is intrinsic value. So the more intrinsic value an option has, the higher your risk of assignment. But we'll save all that for later. I'm not going to give an options crash course tonight. I want to go over this example specifically. So you'll notice here, I'm pretty close to at the money right now because Tesla is at 279.70 right now. So this September 15th, a year out, this is going to be quite expensive to buy into this. So what we would do, because I think, Tesla's a hot stock. I mean, whether or not you think fundamentally that it's going to, stay at its current price, or if you think its current price is justified, it may not be. I don't look at Tesla so much as that. I look at Tesla as more or less of, the volume traded in it and the market cap of of course, the automaker. And I look at it more as a buzz stock. So, I mean, typically, just like Apple, like when after Apple splits, typically it gets back to the pre-split price relatively quickly. Well, I think Tesla a year from now could very well be higher than it is today. So I would go probably further out of the money to reduce the price I paid. And see what I did here? I picked a $600 strike price. And so the estimated total cost now dropped to $1,000. So look at this. Just really pause and understand this here. For less than $1,000, you can control 100 shares of Tesla with a leap option a year out. So, and then if you were to go even higher, say you think Tesla is going to be 700, then now you're only paying 600 for this. And the thing is, like I say, if Tesla gets back to where it was, which it may not happen in a year, you could always go out further. To the furthest out option is actually June 21st, 2024. And you see what happens to the premium. That that it costs. Now, see, here's the thing: when you're buying an option, okay, you're paying the premium to someone else. When you're selling an option to collect premium, you're collecting the premium from someone else. Part of what inspired me to really master this strategy is that trading options the first 6 months of this year, I lost some money in call options just buying them. And then once I really realized, because I knew what a covered call was, but once I really studied and kind of put it into practice, I'm like, you know what? Every dollar that I lost buying options was money that I put in someone else's pocket because whoever I bought that option from, they sold it to me and collected a premium from me. So I kind of thought to myself, I'm going to reverse that now. And, I'm going to now sell options to somebody else and collect the premium from them. Well, what happened? So that, worked for about a month or two. And then all of a sudden in July, we went back to a bullish market for about a month. Now we're back to where we were. So the funny thing, if you had bought into some of these stocks when they hit their July peaks, you would have obviously collected more in premium than you would now. Because if you look at Tesla, just for example, it's already fallen post split. Like it's already fallen probably, I want to say like, yeah, see, it was $309. So it's already fallen over $30. I know I'm rambling a little bit in circles here, but just stay in tune with me because you're going to see where this is going really quick. So, okay, buying the leap option. Okay, just say, okay, this trade goes through. You get into this. We were at September 15th. It cost you $1,000. So now, to add a leg to this, now you're going to sell a call option against it, and you're going to collect premium. So, and you're going to pay attention to these at the bottom here, the bid, the ask, and the midpoint. So you have the bid price and the ask price. When you're buying, you need to pay attention to the ask price. When you're selling, you need to pay attention to the bid price. And you want to get filled, if there's a wide spread, you want to get filled at the midpoint if you can, because you can get ripped off. If you, let me just delete this here. Okay, so here's the thing from market order, and I should have said this just a minute ago. It's going to fill you when you're buying. It's going to fill you at the ask price, which, as you can see, is a whole $1.05 higher than the bid price. So what you want to do, like I would put a limit order in on this, and there's several different types of limit orders you can do. Actually, you can do good for the day, good for 60 days, good until GTD, and you can pick the date. Immediate or cancel, and then my favorite, fill or kill. It's not my favorite. Actually never used that one because it would either fill or kill the order. It would just nix the order. But I like good for the day is what I do. So like I would go. You're probably not going to get filled at an even $9, but you would pick the midpoint between. A good starting point is what you see here. The last point, 920. I'd pick that for starters. And see what you did here by picking a limit order going between the bid and the ask. You just saved yourself $75 on this trade. So part of trading, you don't want to get ripped off when you're placing the trade. And that's what can happen with options trades. You can get ripped off actually placing the trade when you place it as a market order. And that's one thing E-Trade is severely limited in. That's why I like Ameritrade a lot better, because E-Trade will just automatically default to the market price and you'll end up getting filled at the market. But at the limit price, like I said, you're going to get filled. Ideally, you want to try to fill yourself at the midpoint. Funny thing, when you add a leg to it, you have that option. But when you're just buying naked or selling, not selling naked, but when you're buying naked, meaning there's no other leg to offset it or not a spread trade, you're getting filled. You're not going to have that option in the middle. But like I said, when you add a leg to it, in terms of a spread trade, which is what, see the layout here, that's what we're on now. Like you have all these so many different option strategies. I mean, we could talk, if I was going to do an options seminar here, I could talk probably for 2 hours on this. I mean, you have all kinds of, iron butterflies, iron condors, straddles, puts, collars, strangles, you name it. But anyway, this is more or less of a call spread, but this is going to illustrate my example that I'm talking about here. So to finish off that last point, the midpoint, it allows the midpoint here by default, at least E-Trade does on the spread trades. So right now, because you're selling higher, it would still cost you money. But what you want to keep doing, you want to actually go, you want to go further to the actual price of the stock as far as you can, basically. So now look at this here. So if you pick 350, now the further you go, it's like that parable of Icarus getting close to the sun with the fake wings, and then the feathers, the glue melts, and he crashes down. This is what can happen when you're getting too close. It's like getting too close to the sun. If you get too close to the strike price, you're going to risk assignment. And what'll happen if you don't actually have the stock and you make a trade like this, if you get assigned, it's going to liquidate your account. Or I've even heard in some cases you can be short the stock, which kind of sounds crazy. Like you can actually be short the stock, which I wouldn't want that to happen. But just so you know, those are the risks of making a trade like this. But check this out. So this would net you a $3,393 premium without costing you the $28,000 like it would to own the stock. So this would generate, I mean, that's really awesome. And then as things fluctuate, you can do something called rolling, which you can just basically reverse this and then do the same trade again to roll it. And you can keep doing that to avoid, like I say, getting too close to the sun and getting burned. Um, and now see, look here. So this is a pretty tight between the bid and the ask here. The spread is pretty tight on this. But if you really, and I don't recommend this, of course, none of this is recommendations. This is just as educational purposes. But would I do some of these myself? Probably. I actually hold Tesla Leaps right now. I haven't done the premiums on them yet because the stock is so volatile. See, if you went to $300, you saw like really 2 weeks ago, the stock was at 309, so you could be in the money on that, like that. But look how much your premium goes up here, $5,000 in premium. So, but again, you're getting too close. I would think on something like this, possibly going out to maybe like even 400. But again, we see how Tesla moves. Tesla, there's a huge retail following, just like AMC and GameStop. And now that it's cheaper, you're going to see more and more retail investment into it, I believe. So, like I said, you're probably taking a risk when you do something like this. But this concept, like I say, I really wanted to illustrate this because I hear a lot of people that say that they need to own 100 shares of the stock to be able to sell premiums against it, which you don't. You can do a poor man's covered call easily. Let's just see for fun here. If I just preview this order, let's see. Oh, it won't let me do it actually. Interesting. But like I said, for this to go through, you have to have the money in the account at least to cover it. It does come with risk. But like I said, if you map out the trade beforehand and even practice it and simulated trading, you can come out. You can practice that and have a pretty solid idea of what you're doing. This account I was doing the example in, I think I'm actually not approved for that level of trading because I don't have margin in this account. But otherwise, this would have gone through for me. But that's an example there of how you can collect a premium. And what I want to do now, let's see how we're doing on time real quick. Oh, this has gone a while. See, I get ranting about stuff I'm passionate about, and next thing you know, I'm going for 20 minutes. I'll go ahead and make it an even 20, and then I'll end it. Let's just real quick go over another example. And I don't know, this video is probably, option videos on my channel don't seem to get the views that others get. Let's just check out, Mercado Libre. Mercado Libre is one of my favorites still. And like I said, I had some fun with this over the summer. Let's see here. See the same thing. If you were going to go out like 1,000, if you were to buy, this is giving me deja vu a bit because I was doing this over the summer. If you were to go to like say, I don't know, 1,250, and then sell it at 1,000, and this will be our last example. Then I'm going to end the video. Sell it at like 1,000. Oh, that's going to cost you money actually. What if I go to like 950? Ooh, you're not going to get much credit there. But then again, see, the closer you go, you're getting too close. Oh, you know why? Because duh, it expires tomorrow. Um, so going out, let's see, September 2023. Where are you? Does it not have it? Huh. Look at that. It doesn't have a September 2023. So then we'd have to go to 2024 then. Interesting. It hasn't added that. Okay. So, oh, now I have to pick these again. What did I say? 1250. Let's see. Buy at 1250 because the further out you go, the cheaper it is. Just say 1260 because 1250 is not available at this date. So then check this out, $7,558. But the time horizon is huge for that kind of small amount of money, relatively speaking. The time horizon is pretty huge. Anyway, that's really all I wanted to talk about today. September, we'll see how the market goes. It could be a rough month. We got the jobs numbers coming out tomorrow. I'm going to try to keep daily videos up. I'll have more commentary, shall I say, on the macroeconomic environment and all of that tomorrow. We'll see how the jobs report is. I'll do a video on that. I'm going to try to get out daily videos. But as far as today, thanks for watching. Please like, comment, and subscribe if you enjoyed that. And take care.